Hey, I'm Austin Williams. I'm a wealth coach here at Better Wealth. Today, I'm going to be diving into one, very simple question. And that question is, what are you leaving on the table? It sounds super vague. I'm going to peel back the layers here really quickly. But simply put, great first question: what's the table? Answer: the table is opportunity cost. And the question that I'm looking at actually is, what are you leaving on the table in terms of opportunity cost by waiting to get a life insurance policy? Now, every year that you delay getting a life insurance policy actually leaves potential opportunity on the table. Now, this is because, tangibly speaking, insurance is cheaper the younger you are, and as you get older, it gets more expensive. And you're also shortening the compounding period as well as putting fewer dollars into this policy. And this is all assuming that you're putting in the same per year as you otherwise would have if you had started sooner or started later, right? So that is going to be like what we're going to look at here. Now, what we're going to do is we're going to look at two different policies. One is started by a 28-year-old, and the other is started by his 30-year-old doppelganger. Who the only difference is that the 28-year-old has a 2-year head start, and the 30-year-old, both of them are built the exact same way. One just has a little bit more time to kind of hit critical mass. So this one we're going to look at, okay, 30-year-old, they start the policy in 2 years. What's it look like? So this is $20,000 a year is going in this policy. This is an overfunded style whole life policy. So small base, big PUAs. And as you see, 20,000 in that cumulative premium outlay column is going in every year for 20 years, and it gets all the way up to 400,000. So 20,000 a year, 20 years, 400,000. And then I did what's called a premium offset, which is where the dividend is offsetting the base, and so it's pretty much self-funded by year 21 onwards. I took this all the way out to age 51. So the question is, by age 51, with both policies, what do they look like? And so by age 51 here, he's put in 400,000. He has 700,000 liquid cash value, right? So he's almost 2x'd his liquid dollars, and he has 1.95 million of permanent death benefit. This is a great policy. This is a policy that any coach at Better Wealth here would say, hey, this is if this lines up with what this guy is looking to do, if this lines up with what his goals are, this is a really, really well built, overfunded style policy. We wouldn't get any pushback inside the company for the way this is built. Now, imagine that he just gets 2 years more of a head start. So he starts the policy today. Now, 20,000 a year goes in, but for 22 years until age 51, versus only 20 years until age 51. So 20,000 a year goes in, 22 years, so 440,000 goes into this policy. And then by age 51, here's what it looks like. So 440,000's gone in, but it's not just like, you just add 40,000, to the liquid cash value of the first one, which was 700,000. So it's not just like 740,000 or 50,000. It's actually 820,000. So it's 120,000 difference. And the death benefit's not just like a little over 1.95 million. It's actually 2.23 million. It's almost $300,000 of difference. So, and that's the power right here of compound interest and how it can work in your favor over a long period of time. There's 120,000 more cash value and almost 300,000 more death benefit from just $40,000.
Hey guys, I just wanted to interrupt real quick. If you're watching this and have an indexed universal life policy, a whole life policy, have any type of insurance policy in general, and you're like, I want to know if I'm on the right track. I want to know if this is set up properly. We at Better Wealth want to help you. We want to give you a free policy analysis and show you, are you on the right track? Is there some things that you potentially could be doing better? And so we have a link down below that you will have access to. We would encourage you, if you have a policy and you want to see if you're on the right track, check that out. And if you're someone that's watching this and you're like, I want to talk to someone maybe setting up a policy for myself, or I have questions, we would love to serve you. You can also see a link to have a call with someone on our team. Back to the episode.
Now, the upshot of all of this, the earlier you start, the more time that you allow compound interest to work in your favor. The cost of delaying a life insurance policy is both tangible and intangible. The tangible part is probably the easiest part to wrap your head around. It's just that, as you get older, insurance gets more expensive, and you're just going to have to deal with that the longer it takes for you to start. Now, the intangible bit here is the opportunity cost. It's what you're leaving on the table. Now, to be very fair, some people might look at this and say, okay, 40,000 over 20 years turns into 120, right? I think that this guy could have put that money in some alternative, some investment, and it earned a better rate of return over the 20-year period. So if that was the case, that he would have been wise to just not to just wait till he was 30 and fund it, and just keep that 20,000 a year and put it somewhere else. And you know what? I'll say that could be a fair way to look at this. I'm not going to say that's the wrong way to look at this. However, if he was 28, and let's say that he knew about that investment and he still started funding when he was 28, he could put the money in this policy and still invest in whatever that was by borrowing against the cash value. Except then he has whatever the rate of return is on that investment over 22 years, plus the extra gain that he experienced inside the policy via compound interest. And then 22 years later, he can just pay off, whatever that loan has grown to. And then he has the gain that he experienced over and above the policy loan, plus the gain of just the compound interest inside the cash value and the growth in the death benefit. So, that's ultimately, what we're trying to get at is, what are you leaving on the table? If this strategy of overfunding life insurance aligns with your goals, and if you like the idea of having the and asset, it's always better to start earlier. So that's it. Thanks so much for watching. Appreciate you. Have a great rest of your day.